In a world where markets hit record highs while risks multiply, how should you position your portfolio? Today, we'll explore the critical balance between investor caution and confidence in an age of uncertainty. Recent years have presented markets full of seeming contradictions. Optimism and anxiety coexist. Geopolitical tensions, inflationary pressures, and governmental gridlock dominate headlines. It can be challenging to know how best to approach investing when it all seems to be up in the air. Hello, I'm Layla, Sean Sparkman's AI narrator. This video is based on an article by Sean Sparkman, published on safemoneytrends.com. We'll discuss how, in an age of uncertainty, investors must keep a close watch on their portfolios and never become complacent. Despite pervasive uncertainty, equity markets continue reaching unprecedented highs. This paradox demands that investors temper exuberance with caution, recognizing that short-term gains may obscure deeper, systemic long-term risks. Maintaining investment discipline and taking the correct action remains critical. As market dynamics evolve, yesterday's portfolio construction may prove inadequate for tomorrow's challenges. Adapting to shifting conditions can transform volatility into opportunity, while complacency amplifies risk exposure. Let's examine the risks underlying recent rallies and the structural changes that may yield unexpected opportunities. Recent market performance provides a clear snapshot of today's contradictions. Global equities have achieved new highs, with major indexes across the United States, Europe, and Japan all advancing substantially. Wall Street's S&P 500 and Japan's Nikkei reached record levels amid the artificial intelligence boom that accelerated in 2024. Moderating inflation and robust corporate earnings have bolstered investor optimism. Declining bond yields temporarily raised expectations for accommodative monetary policy. However, these monetary efforts have achieved limited success in addressing underlying structural challenges. Simultaneously, fiscal deficits are expanding dramatically, and political dysfunction continues straining international relationships. These factors create a complex risk environment that demands careful navigation. The latest market rally has predominantly stemmed from disciplined investment approaches. Many investors have favored companies demonstrating strong earnings power and solid balance sheets, eschewing speculative or unprofitable growth ventures. High-quality fixed-income securities have regained popularity. Given substantial uncertainty, the migration towards safer, more fundamentally sound investments represents rational risk management. These trends indicate markets are undergoing transformation rather than reflecting investor complacency. The same forces propelling markets higher are simultaneously altering risk dynamics and correlation structures. Economic nationalism, expansive government spending, and technological innovation are reshaping asset behavior patterns and the sources of long-term returns. Understanding these shifts is essential for portfolio positioning. Market leadership is experiencing significant rotation. Recently, a concentrated group of growth-oriented and AI-focused equities have dominated performance, but historical precedent suggests such narrow leadership rarely persists. As valuations expand and expectations escalate, the probability of disappointment increases proportionally. Sectors including industrials, financials, energy, and materials are attracting increased capital allocation as investors seek diversification. Small and mid-capitalization companies, which have underperformed during the recent rally, now offer more attractive valuations and greater potential. This doesn't mean abandoning growth equities entirely. Rather, it emphasizes that valuation discipline is paramount when markets trade at elevated levels. Portfolios concentrated exclusively in recent winners may prove vulnerable to rotation. Diversification across investment styles, economic sectors, and market capitalizations is much more of an active exercise. To make things even more complex, economic nationalism is fundamentally altering global relationships. Trade barriers are rising, supply chains are regionalizing, and immigration policies are tightening across developed markets. As United States growth moderates and other regions experience catch-up growth, currency fluctuations are bound to significantly impact returns, making active currency management and diversification increasingly crucial. This makes global diversification and active currency management increasingly crucial. government spending continues to transform both policy frameworks and market dynamics. While fiscal expansion supports near-term growth and infrastructure development, it simultaneously increases sovereign debt burdens and inflation volatility. Equities and fixed income are now more closely correlated. This diminishes the effectiveness of a traditional 60-40 portfolio. Rapid technological innovation continues to disrupt established industries. Increasing value creation is occurring in private markets and within mature, cash-generative companies rather than speculative ventures. For public equity investors, the performance gap between winners and losers is widening, making passive index exposure increasingly risky as index concentration grows. For these and other reasons, portfolio resilience requires flexibility, a global perspective, and diversified return sources. Investors must look beyond traditional equity and bond allocations to alternative return streams. One critical yet frequently overlooked risk is portfolio concentration. A small number of large technology companies now dominate equity indexes. This has enhanced returns but simultaneously increased market fragility. Historical analysis tells us that most individual equities underperform broad market indexes over extended periods, often creating significant, permanent capital impairment. Exceptional winners are rare. Even the most successful companies can endure prolonged periods of volatility and drawdowns. The implication is clear. High-conviction positions must be balanced with portfolio flexibility. When you have such a limited number of winning stocks or sectors, it tends to amplify losses, especially during market dislocations. After years of diminished relevance, fixed income has regained strategic importance. Higher yields provide enhanced income generation and some protection against equity market volatility. However, persistent inflation risks and evolving asset correlations suggest bonds alone may not provide sufficient diversification. A more comprehensive approach incorporating alternatives is necessary. This is why alternative investments have become essential portfolio components. Assets including private equity, infrastructure, real assets, gold, and hedge funds can provide uncorrelated return sources and downside protection during market stress. Private markets provide access to innovation and growth opportunities unavailable in public markets. When markets exhibit contradictory signals, the optimal approach balances maybe long-term strategic discipline with tactical flexibility. A robust strategic framework maintains portfolio alignment with investment objectives, risk tolerance, and income requirements. At Pathfinder's Wealth, our portfolio design objective is not to achieve perfect market timing, but to use intentional, evidence-based portfolio management. This may require systematically rebalancing appreciated positions, broadening diversification, and ensuring portfolio construction reflects both opportunities and risks in the current environment. We believe that thoughtful adaptation supersedes prediction. Adopting a global investment approach with active currency risk management is crucial for capturing opportunities across regions while managing exchange rate volatility. By expanding their investment toolkit, embracing global opportunities, and proactively managing concentration risk, we help our clients construct portfolios positioned not merely to withstand uncertainty, but to capitalize on it. Let's recap the key takeaways for positioning your portfolio in this age of contradiction. First, diversification has evolved from passive to active. You'll want to spread investments across styles, sectors, and market capitalizations to better manage concentration risk. Second, alternative investments are now essential for many people. Private equity, infrastructure, real assets, and hedge funds provide uncorrelated returns and protection during market stress. Third, you and your advisor must adopt a global perspective with active currency management. As growth broadens beyond the US, currency fluctuations could significantly impact returns. Finally, it may be wise to invest in secular trends but maintain valuation discipline and selectivity. Concentrated portfolios with no diversification may cause unnecessary risk. Thank you for watching. We hope this video helps you navigate portfolio positioning in today's complex market environment. Pathfinders encourages you to stay disciplined, stay diversified, and stay informed. Be sure to contact us today with your questions and concerns.